Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And I was about to pack my bags and wrapping up all my filming before leaving for the Blossom for the Blossom event. But I keep getting messages about this video that Ben Felix came out with, like you saw in the thumbnail. Covered calls a devil's bargain. Definitely a nice little title there to attract clicks, of course. But in that video, so the thumbnail says it's not income, and then in the description it says the idea that covered calls generate income is financial bull crap, right? So basically saying covered call income is bull. So is he right? Well, let me start with something, and you can watch the video for yourself. I'm not going to play some clips, but I recommend you definitely watch the video through and through. Let me give you my thoughts and my points on it. If you want, pause this video, watch his video first, and then come back to see my opinion. So the first thing, a couple of things I want to address that he talks about in the video, especially near the beginning. He talks about how covered call ETFs have increased risk, right? So I found that kind of amusing. I think what he's trying to say is the increased risk of underperformance, of less total return. Or he talks about the fact that covered call ETFs take all the downside. Of course, there are those call option premiums that cushion the downside, but technically speaking, you could say the assets inside are taking all of the downside. But of course, when market goes up or market recovery, you're giving up a lot of the upside. So he's saying that increases the risk. I don't think I agree with him there. I think, and this is why when you go to any covered call ETF website, it says lower volatility. I think the risk is, if you're talking about risk as in volatility, I think covered call ETFs have lower risk. If you're talking about, they have risk of underperforming, but that's a little bit different. But I love how these growth guys and these index bros, which is fine. I mean, it's a great way to invest. They always manipulate these words. But what about the risk of, and Ben Felix pretty much recommends, index funds, right, all the time, which is great, which is fine, which I think are great too. But my point is, what about the risk of needing to sell in a bad market? What about the risk of panic selling? What about the risk of losing sleep because you're faced or about to face the eventual drawdown dilemma, which of course financial planners could help you with, right? The risk of wasting so much time and energy looking at stock prices all day because you're fully dependent on them going up and you're fully dependent on you selling at one point to actually realize any money. So you see what I mean? So risk means different things for different people. There's many forms of risk in terms of investing. But if you're referring to risk in terms of returns, which I think he's doing here, why is fixed income then considered low risk? Bonds, long-term government bonds, these are considered super low risk, but shouldn't they be high risk because their returns suck? You see what I mean? Doesn't really make sense. So let's go with I think, which is probably the most important premise of his video. Two important premises, which I full on agree with. Okay, so he says that high yield income, well, I kind of disagree with how he says it. He says that high yield income, or high yield ETFs, if you will, is promoted as return. I don't know any fund manager, especially in Canada. I know for a fact that it's even illegal for them to do it. They're so stringent on the rules that the OSC told all Canadian fund managers that they're not even allowed displaying yield unless the fund has been out for a year. So in Canada especially, I don't know any fund manager who's promoting these high yields as returns. I've never ever seen that. Even in the US, of course, Yield Max is always the scapegoat, right? Yield Max has the really, really high yields. I don't know anyone at Yield Max or seen any official statements from them promoting yield as return. So I don't know exactly what the heck he's talking about here, but I do agree that there is a connotation. Maybe YouTubers are doing this. Definitely not me. You hear me say all the time, guys, yield is not return. So when he says that the fund managers are promoting it, yield as return, I think it's complete nonsense. But he's right in the fact that if anyone is saying yield is return and trying to promote it as such, then it is BS, right? Yield is not return. I say it all the time. I see, and people tell me all the time, Adrian, you're getting a 20% return, which they're referring to my yield. And I'm very quick to correct them. No. That's my yield. That's my annual distribution yield. It's not my return, right? So remember, everyone, very important point, and probably the most common mistake income investors or newbie income investors make in the space is that they think covered call ETFs or these high yield funds are kind of like annuities or GICs. They're going to park their money, their capital is going to be fine, and they're going to get that 40% annual yield. It's not the case, okay? You can't invest in a 40-50% yield covered call ETF and think, well, I'm just going to live off the 40-50% yield forever. No, it's not accurate, and in fact dangerous to think of them in this way. So for this point, I 100% agree. Again, it's a matter of education, right, in the end. Now, I think the next thing he talks about, and this is primarily the bulk of his video, and this is primarily the bulk of any negative post or video and any other YouTuber like that obnoxious kid with the spiky hair, passive income investor or whatever, who recently talked about my portfolio and Blossom or whatever. They always give a bunch of examples of covered call ETFs that underperform the underlying, right? So in this case, typically QYLD is always the scapegoat in the US, typically QYLD versus QQQ. In this video, he goes over a bunch of BMO covered call ETFs. He talks about JEPI. Like I said, I don't think he talks about QYLD, but he always, it's a scapegoat one. He even talked about SMAX from Hamilton ETFs, which is actually doing not bad versus the S&P 500. But I just find it funny that these guys never talk about bond or fixed income ETFs like ZAG from BMO or TLT. Nobody ever looks at those total returns, right? But anyway, yes, I do agree with him that most covered call ETFs out there will underperform the underlying. I actually did a video on this called The Honest Truth About Covered Call ETFs. And in that video, I say that it's pretty much impossible for an S&P 500 covered call ETF to beat, in terms of total return, the S&P 500. Okay, this is a known thing, and this is for two reasons in particular. Of course, you guys already know the reasons. One, they have higher fees, and two, if you're giving up upside and the asset is going up over time, of course you're not going to get the same total return. You're giving up upside. Those premiums are great, the income is great, but it's not going to make up. There's still going to be a total return lag. But here's the important point. This is my response, or this is what you could respond to all these guys that say this. Remember that not all covered call strategies are created equal. I repeat, not all covered call strategies are created equal. So most of them that they use, these are what I like to refer as a steam engine strategies, kind of like what QYLD does. BMO has a passive strategy. So these strategies, these returns, of course, they're not gonna outperform the indexes or outperform just holding the assets by themselves, but they're not designed to do that, right? Just like fixed income is not designed to outperform equities. But what I will say is that we have new covered call strategies now that are doing really, really well. The performance is much better, right? And I'm going to show you a bunch of examples in a second here in total returns that these guys never look at. They're very specific with the ETFs they select. But I do agree that most of them, covered call ETFs out there, are underperforming and will underperform the underlying, right? But this is why it's important to stay on top of the landscape and the new covered call ETF strategies that come out, and that's why it's important you subscribe to the channel, because that is really what my channel focuses on. So he talks about fees as well at one point, but we all know why they have higher fees. But that whole fees argument, that kind of ties into total returns, because total returns are net of fees. So I put fees in that bucket or that category. But now let's check out some of our own examples of total returns, shall we? So let's look at some total returns, everyone, right? Let's look at one of the OG. This ETF's been out for a long time, HDIV, a really good one. Look at the total return since inception. This is since inception. This is not even HDIV 2.0 when they kicked out all those third-party ETFs, and now it's all the Hamilton ETFs. So HDIV even got better with time. But this is still from inception. Versus XIU, versus the TSX 60, right? Give me the whole Canadian market. HDIV is outperforming it by a lot. Here's some total return. Now, in terms of, it's even outperforming if you're spending all the dividends as well, right? Look at the total returns even without dividends reinvested. But with dividends reinvested, it's destroying it, which means it has higher total return than a index fund, right? What about the very popular VFV? HDIV is outperforming the S&P 500. It's outperforming VFV. Oh my God, right? Nobody ever talks about these ones, right? They're very selective. With dividends reinvested. Dividends not reinvested, it is not outperforming. It's still counting the dividends though. But it's simulating as if you're spending them. If you do that, well, then the total return is not. But keep in mind, for example, let's say you do a total return comparison of HDIV versus VFV and you're living off of VFV. Let's say you're selling a little bit of units of VFV every month, while HDIV you're not, you're just living off the income. The return is going to be lower in VFV as well if you're selling units every month as well, right? You guys understand why, I'm sure. What about HYLD? An S&P 500 style covered call ETF. Let's do it versus the Vanguard S&P 500 hedge the Canadian dollar, because HYLD has hedged the Canadian dollar. HYLD since HYLD 2.0, since the beginning of 2024, is outperforming VSP with dividends reinvested, without dividends reinvested. Why don't they ever talk about this one? If they do, they'll probably do it from inception. And to be fair, from inception, HYLD is not outperforming VSP. But we know, you guys are in the community, you know that HYLD became completely different as of approximately early 2024. What about USCL? USCL is an S&P 500 covered call ETF versus VFV. Very, very similar total returns since the beginning of 2024. Without dividends reinvested, it's underperforming. It's underperforming as well with dividends reinvested. But look how close it is, right? You can't call something BS just because it's underperforming, okay? I mean, seriously. QQCL, NASDAQ 100 covered call ETF versus the NASDAQ 100. It's outperforming. Dividends reinvested starting in 2024. Dividends not reinvested, it is not. But again, for the same reason, because you're living off the income. In that case, if you're doing the same thing on QQC, you're selling units of QQC every month, well, you're not going to get the same total return. Let's do, and they're probably going to say, oh, well, that's because those have leverage. Those have 25% leverage. Yes, they have 25% leverage, so that technically increases the risk. But again, risk is in the eye of the beholder. So yes, you're technically increasing your risk because of that leverage. But what about the massive reduction of risk, which I think is zero, because you don't need to sell anything and you're holding them forever? That to me makes these much lower risk, if anything, zero risk, in my opinion, right? Risk in the eye of the beholder. But if we do ESPX.B, this is the Evolve S&P 500 covered call ETF. No, not hedged to the Canadian dollar. That's why I selected the .B. I'm doing it versus VFV. No leverage, and look how close it is. It's underperforming, fine, but it's kicking out a nice level of income that you could live off of, so you never have to sell it, unlike a VFV, which you're going to have to sell. You see what I mean? Let's go on the U.S. market. U.S. market, they don't really have lots of leverage. They don't have any leverage ones yet, lightly leveraged one yet. But let's look at what I call the basic one, GPIX, the Goldman Sachs S&P 500 versus the S&P 500. It's not that bad. It is underperforming, but the goal is not to outperform everyone. He does the JEPI comparison, but I don't really like. I think JEPI is best more compared to SCHD because they're stock selecting in the S&P 500. GPIX is really the S&P 500 covered call ETF. So I think this is a more accurate description. But of course, this is a good example where, yes, it is underperforming, fine. But the fact that you could just buy and hold GPIX forever, live off the income, that reduces the risk as well. And it's not designed to outperform, right? But just because something is underperforming its benchmark doesn't mean it's BS. What about T-SPY? T-SPY is one of the one that's not leveraged and is actually one of the best ones. It's actually, the performance is very, very, very close to VU, and I'm of the opinion that it's going to eventually outperform VU. It was outperforming it for a while. Then there was that 1 day big jump. And you know, I don't want to get into it, but I made a video about it. But look at the performance, very, very, very close, very nice compared to the S&P 500. How come nobody ever talks about these ones? They always poop on yield max, but they never do a Y max, which is, you know, all of the yield max ones put together against VU. It's actually doing fairly well. It's underperforming, yes, but performance is actually pretty good, and you get that high level of income. But this one has a really, really extreme yield, which is why that if you're spending all the dividends, which I would never recommend for something that has super, super high yield, you see that there is a performance gap. But with dividends reinvested, if you just put it on drip, it has a pretty good performance. Last but not least, TLT versus a TLT covered call ETF. Because TLT has been so crappy lately, you see that TLTW, the BlackRock TLT covered call ETF, is outperforming TLT with dividends reinvested and with dividends not reinvested either. So covered call ETFs, you know, during a sideways or bad market, and I think he talks about it, they can outperform, especially if it's a long period of time. You have the proof right here. So in short, everyone, typically all negative posts and videos and criticism that all these guys do on covered call ETFs in particular, it essentially all comes down to total return, right? That's the basis, that's the fundamental basis of their argument. You could sum it all up as they underperformed their benchmarks. You will get less total return than just holding the S&P, just holding the 6 bank, whatever it is, you'll get less total returns. And that is true for most of the time, but there's, like I showed you, there's some covered call ETFs with newer, more improved strategies that have a little bit of leverage that the returns are actually pretty good. But these growth fanatics never talk about is all the benefits, all the psychological benefits that investing in covered call ETFs, or kind of doing my style of investing, buy and hold, have, right? What about reaching fire early? I'm the perfect example, retiring early, right? I technically retired from my 9 to 5 in our mid 30s, and I get messages all the time of people that retire 5, 6, 7, 10, 15 years earlier. What about the total return for that amazing benefit, which could literally transform your life? They never talk about that, right? I'm the perfect example. We owe everything. I owe all the success we have to PII, for my wife being able to quit her job that she didn't like, which led her to having more time to actually work on the YouTube channel, which led me to eventually quit, which led me to start our Fire Life 2.0, which led us to Panama. What about those total returns, right? Right, Ben? What about those ones? Imagine retiring 5 to 10 years earlier, right? That you could experience the world now. Maybe start a business, do some volunteer work, a hobby you always dreamed of doing. You have the time. What about that total return? There's so many psychological benefits of my system, of the covered call ETF system, if you will, the PII system, of never needing to sell. They always talk about total returns, but it's all unrealized until you sell. It's all unrealized until you sell. So when do you sell? How much do you sell? How do you do it? How do you draw down? Oh, wait, I'm a financial advisor and a financial planner. I'll be able to help with that, but only if you pay me this much, right? So covered call ETFs eliminate all this problem. They eliminate the biggest problem, I think, with growth investing, which for the record, I think, or just holding index funds, which for the record, I think is a fantastic way to invest. That works. That's really, really good. But you're going to have a drawdown problem eventually, everyone, right? Trust me, I met with over 1,000 people. It's always the number one concern they have, and this is why they typically transition. What about sleeping better at night? Isn't that a great total return? What about not worrying about market crashes all the time, right? Because why would I worry or care about a market crash if I'm never going to sell anything? Growth or index funds, they could go down 10, 20%. Well, you haven't sold anything, so you see your capital go down 10, 20%. So what about not worrying and not being stressed about recessions and depressions and flash crashes or whatever they call it these days, right? Isn't that a great total return? What if you have some sort of emergency that month and you have to sell shares? And if you only hold growth or index funds, you kind of won't gotta sell shares. What if the market is down that month? Covered call ETFs, you have the flexibility to use that cash however you want for whatever you want and whatever you need in your life in that point. And you have the ability, if you want, to reinvest the rest or reinvest all of it without selling anything. Flexibility. Isn't that a great total return? That's one of my favorite parts of PII, right? Tim and I talked about it in the latest PII testimonial. He loves going shopping, right? He hates shopping at the mall, but he loves going shopping. It's really flexibility. What about the fact that these ETFs or covered call ETFs enable you to never need any fixed income crap? You don't even need dividend stocks anymore, right? Which is a huge plus now in terms of returns, because back in the day, dividend stocks did really, really well, or maybe even outperformed the S&P 500 in general. But I think the tide is turning, and this is why I have another video showing how, for example, GPIX or many S&P 500 covered call ETFs are outperforming SCHD, which is a collection of quality dividend stocks. Well, that's because a lot of these amazing technology growth-focused AI companies don't have dividends. So having a covered call S&P 500 or NASDAQ 100, this prevents, you don't need to focus on dividend stocks only now, which is a big problem I feel with dividend investors or dividend growth investors. You're only investing in dividend stocks, but what about Palantir and Coinbase and Strategy and stocks that don't have a dividend? These are or AMD or Nvidia or Amazon. Yes, Nvidia has a little dividend and Meta has a little dividend, but typically those still don't get added to dividend ETFs, right? So isn't that a good total return? You don't need fixed income crap, which is just terrible returns, or dividend stocks, which I feel are going to continue to underperform the overall indexes. What about the fact that these ETFs enable you to never need to sell anything? Think about that. You never have to sell anything. You know what a huge plus that is? My opinion, this renders my risk, personally, I think my risk is zero. Because if you're just going to buy, think about it. If you tell, this is my question to a growth investor. If you're just going to buy the S&P 500 or a NASDAQ 100 and hold it forever, and you plan on never, ever, ever selling it, isn't your risk technically zero? But you can't do that with index funds. You have to sell at one point to realize, unless you have $50 million and you can live off that 1% yield. You guys know what I mean. But isn't it a huge plus that cover call ETF investors or people who use my system never have to sell anything? Isn't that a great total return as well? So I think his video is more good than bad, because he's right. Yield, and this is in summary, guys, yield is not return. Anyone who says that or thinks that is really bullshitting, right? And they're right. And he's also right that a lot of covered call ETFs, most of them actually will underperform just holding the underlying. But there's a lot of asset classes that underperform equities and the S&P 500. So why do they exist, right? Total returns is very important, but it's not everything in investing. It might be for you, and that's fine, but other stuff can be more important, like all the positive and psychological benefits I just mentioned, right? Imagine you're in your 60s and now you're still working, and well, maybe with my system you could have retired 5 to 10 years earlier. Wouldn't you sacrifice maybe a little bit of total return for that? I think most of the answer, maybe if you're young, you're going to say no, but trust me, when you get to that age, you'll say yes. So myself personally, everyone, my quest is to find the best of both worlds. I want that consistent cash flow with with the yield, but I also want really good total returns, right? Or at least as close as possible to just holding the underlying. And now it's possible with the better strategies out there, the lightly leveraged products. So this is why I'm always on the lookout and follow the landscape closely, right? I personally, right now, I could sell everything and go in index funds. I could do that because I technically don't need the income from my passive income investing portfolio because of all my other sources of revenue. But I choose not to because of all those fantastic benefits I mentioned, and because of now you have covered call income oriented funds that perform very similarly, and some even are very, very close identical, and some even better, like we saw, better than the indexes, right? So I don't really understand why he says the income from covered calls is bullshit. I mean, I think I could say with 100% certainty, and many of you watching, of course, will agree with me, that when the income hits your account every month, it's not BS, right? Just remember that the income is part of the net asset value of the fund that is being returned to you as an investor, right? Maybe this is why he says that it's not income in his thumbnail, because it's part of the NAV and it's being returned to you, so it's not technically income. But he discusses fixed income and how I guess he believes that those generate income, but these funds don't. So I think that's complete nonsense, right? The premiums received from selling call options, what is that? It's not income. It's part of the NAV. So I think he's just playing semantics here with words. That's just my opinion. So I agree. Yes, yield is not return. It's simply a portion of the NAV being given out to you, investors. But that enables us to have all the benefits that I talked about, and I'm sure many of you are already experiencing as well. But when you buy index funds and start selling shares to draw it down, isn't that the same thing? You're selling part of the NAV anyway, right? So this is the big problem covered call ETF investors, PII investors, don't have. And therefore we don't need financial advisors, right? But to call something bullshit just because it underperforms, well, to me, that's bullshit. Okay, my guess is that I know this for a fact. Financial advisors, they hate covered call ETFs. Most of them do, because if people would invest in them and just do my type of system, they wouldn't need a financial advisor or planner. So of course they hate them, right? It's only normal, because they act like, well, we could help you with the drawdown problem. Well, covered call ETF investors don't have that problem. So therefore, I asked Ben, I put a comment on his channel. Your premise is essentially all that matters is total returns, right? That's essentially the premise of all these posts, and they could be a million pages, but that's basically the premise. But my question to them, or to Ben, is if that's the case, why don't you advise all your clients to simply manage their own money and buy index funds? No need to manage their money for them and charge them a fee, right? And he writes, I do tell people to invest in index funds. They definitely don't need me for that. Investing is pretty easy. I agree. It's all the decisions and planning connected to it that people tend to want help with. And I reply, and that's exactly why I love covered call ETFs. It renders those decisions and planning much, much easier. I do agree with the general premise of the video, which is in the end always comes down to total returns. But keep in mind, not all covered call ETF strategies are created equal, like I showed you guys. See you in Toronto. He's going to be at the Blossom event as well. So guys, hopefully this video was informative for you. Give me a thumbs up. Let me know if you have any comments or questions or concern if something's not clear to you. But I think, I think it's these types of videos and thumbnails and negative posts on covered call ETFs will continue. In the end, I think the general premise is all about total returns. But my response is two things. Number one, they're not designed to outperform. Number two, yeah, a lot of them do, and those are the examples that you fixate on, but you're not fixating on the better and newer covered call strategies, which is what my quest is all about. I want yield. I want the best of both worlds, the yields and the total returns. And now, because of all these great funds coming out, we could have it, right? But just to say something is a scam or BS, or these types of product cover call it, to say that they're scams or BS just because they underperform, well, I think that's BS. Take care, everyone. See you next time.